Okay, well, good afternoon, ladies and gentlemen. Welcome to this IFR Conclave, which we've entitled The Impacts of Brexit on Capital Market Regulation. So my name's Keith Mullin. I'm IFR's editor-at-large, and forgive the slightly sort of odd setup with us speaking to a virtually empty room, but we are actually videoing the conversation. So I'm aware that, as we said before, there are no answers to the question at this point, but I thought it'd be quite instructive for us to have a fairly open, informal debate around some of the talking points to see if we can get close to some kind of preferred direction of travel around the key issues. I'm also conscious that there are a number of issues out there. We're not going to get in the next hour or so into the sort of the nitty-gritty of specifics around MiFID II or passporting, whatever, or the various options that have been floated around this. But we consciously chose for this, our inaugural Brexit session, to have a panel of lawyers and consultants. And we will be following up with a series of these events with bankers and perhaps investors as well. And so please feel free to chip in on each other's answers. It's meant to be kind of fairly informal, open and flowing conversation. As I say, we'll go for about an hour, which I know is relatively short, but we figured it was a good kind of amount of time just to get the issues out there. And so in terms of, we'll kick off in a second. I'm going to ask Thomas Huertas from EY just to kind of open the conversation. But before we did, I thought it would be useful just to go around the stage with a few quick introductions. And so...
Hi, so I'm Leonard. I'm head of Akin Gump's UK and, for the time being at least, EU Financial Regulatory Group.
Okay, thank you.
I'm Kate Sumpter. I'm a partner in the Financial Services Regulatory team at Allen & Overy, and I tend to focus on sort of bank regulation, prudential issues.
And I'm Dawson. I'm a senior associate in the financial regulatory team at Clifford.
I'm Tom Huertas. I'm a partner in the risk practice at EY, and I chair the firm's global regulatory network.
And my name is Rosali, Pretorius, and I lead Dentons financial markets team.
My name is Michael Lewis, and I'm a financial services regulation partner at Pinsent.
I'm Imogen, Garner, and I'm a partner in the financial services regulatory team of Norton, Bright.
And Andrew Davidson. I sit within KPMG's Regulatory Centre of Excellence, looking after banking developments.
Okay, thank you all. So, Thomas, there's been an awful sort of lot of speculation, gossip, panic around this issue. It's early days. The referendum was only, certainly a few days ago. So when you first saw the theme, impact of Brexit on capital market regulation, what immediately sprung to mind?
Well, I think you need to put it into a broader framework, and it's the broader framework that will ultimately drive what happens to capital market regulation. Perhaps we might just run down briefly using the traditional reporters' questions. Let's leave why aside. We don't want to divert ourselves into that. What is going to happen? The UK is going to leave the EU. When will it happen? Well, the actual departure is at least some 2 years off, and the how it will happen is the big question. The technical aspects of how it will happen is that the UK at some point will file a so-called application under Article 50. But the real question is, what is the arrangement going to look like after the UK leaves? And there are three different models that people have talked about. One is Norway, where the rights and obligations of the EU are maintained. The UK has the same rights and obligations in the EU, including passporting, but it has no vote, and it importantly has to pay the money. Canada, a free trade agreement is between the UK and the EU, and then Albania, a third country under the rules of the WTO. very, very different implications for capital markets regulation and capital markets in the UK. Norway is very much the world as we know it, an ability to continue the current practice. But with that situation comes the free movement of people, which is exactly the issue that was of most concern in the campaign. And finally, the question is who? Awful lot of discussion, of course, about who the next prime minister will be. But importantly, the who on the other side of the negotiation, the EU 27, will change or potentially change over the coming 2 years. There are elections in France, elections in Germany. There's an important constitutional referendum in Italy. So who's on the other side of the table is an important factor in this development as well. So an awful lot of questions, as you indicated, but the model that one winds up with is going to be, at least in my opinion, determinative of the way capital markets are allowed to function in the UK and will give a strong indication of capital markets regulation.
Okay, thank you. Let me come to you for my Christopher. So one of the big talking points in this entire debate to date has been this notion of whether the UK gets equivalence. Now, let's perhaps gate over the issue of what the give-ups might be around migration, because that's, I guess, a different issue, although it's clearly related. On paper, equivalence sounds fairly simple. Is it on the table? Is it achievable?
Well, first of all, I think the most important point is, absolutely the model that is eventually adopted is going to drive all of that. And that becomes a very political discussion. And it's also just worth saying that, it's important not to think of the financial services industry as a whole, which I think, certainly in the discourse to date, it has been just sort of passporting banks. Not everyone uses passporting, not every aspect, not every sort of silo of the financial services industry uses passporting in the same way. And I think there will be different drivers within the industry and different interests being advocated. But when you look at equivalence, and the way it works within different regimes, banking, MiFID, insurance, they're slightly different. But the fundamental point is that at the point of departure, whenever and however that might be, the UK's law won't actually just be equivalent to that in the EU. It'll be exactly the same as the law in the EU. Now, then we may have stepped onto a path where we begin to diverge. There may be good political reasons why we choose to do that, but as I say, at the point of departure, the law won't just be equivalent. It'll be exactly the same. And so the question that politicians, I guess, on both sides of the channel, but also for industry participants will be, well, do you want to maintain that equivalence? Do you want to recognise that equivalence? And what mechanism, if you choose to maintain the equivalence, what mechanism do you use to sort of try and keep the UK and the rest of Europe marching in parallel in our different futures?
Because, Kate, one of the issues around equivalence is, of course, the EU directives that get transposed, they're not EU, they're the UK laws, but clearly there is regulations that effectively just take effect. And on day one of, T+1 of exit, the regulations basically cease to have potentially, any kind of legal resonance at all in the UK. So how does one prepare for that in the event? I know that there's talk about exit from Brexit. Let's assume that that's not going to happen, and we exit. We do Brexit. We do have this potential period of, well, what's going to replace the EU regulations that are not actually part of the UK legislative body?
There certainly is at this stage, Keith, a real possibility of a lacuna, as it were. I think we have to have some degree of faith in the parliamentary process that they will pick up on the fact that we can't simply eradicate the European Communities Act of 1972 and all of its effects, and that we do need to address the possibility of a lacuna in respect of directly applicable regulation. Precisely how they will do that, I think, is open for speculation. But it does go to the very heart of Christopher's point about the law being exactly the same. I think that is absolutely a sensible assumption, but I think it is just that, an assumption. Even aside from sort of regulations, as it were, we do have the very substantial tasks ahead of us, just to name two, the Recast Payment Services Directive, MiFID II, both of which are due for implementation over the course of the next 18 months. There is a risk that the UK authorities actually decide we're not going to go down that route. We're not going to implement those pieces of European legislation. And I think at that point, we will have divergence on day one. Now, as I say, I think Christopher's assumption is a fair one, but it is just an assumption.
There have, of course, been some areas where we have seen some differences between the stance that the UK has been taking versus the stance that's been taken by the European institutions. So look at things like the bonus cap. At the moment, some of the noises that we're hearing are very much MiFID II, expect to have to comply with it, business as usual, carry on implementing. We'll see where that goes. Things may change over the period, they may stay the same. At the moment, the message seems to be assume that you will need to comply with anything that comes into force during the period of the negotiation, because we will still be a member of the European Union during that time. But there's everything out there to consider.
And I absolutely agree. And you're right. It is an assumption. In terms of how you might bring those regulations into effect on the day of Brexit, it would presumably be a relatively simple statute to say, as of the day of Brexit, these regulations will apply until there's a specific thing. But I think your point is really important and valid, which is there is already that slight tension between the London model, the London regulators, and what the rest of Europe has probably been restraining at the leash to do previously, and has been restrained from doing so by the presence of London in the UK in the Union. And that now that restraint is taken away, it is absolutely a question as to whether the direction of travel in Europe becomes so unattractive to London businesses that we don't want to keep on marching in step.
Rosali,
sorry.
please.
I think it's not as if all restraint will go away, because following the financial crisis, we're part of a system of global regulation. And I think there's recognition here that whatever we have has to be at least along the lines of what we've agreed under the G20 commitments and so on. So I think on things like bonus cap, there may be differences. And the question is going to be whether those sorts of differences actually will railroad an application for equivalence. On equivalence, by the way, I agree with you that there's nothing in there which says it will be automatic. But on the other hand, there's also nothing in there which says that, for example, the European Banking Authority couldn't actually start looking at equivalence ahead of an actual Brexit date. I mean, that possibility is out there as well.
No, I think the only issue, of course, is that equivalence is ultimately a political determination in the hands of the Commission. So we all as practitioners we could do our little flow charts and our comparative diagrams and say, well, this is the same, and ultimately that's not what's going to drive the decision.
So two questions then. First, let's assume that the law is exactly the same, and there is therefore equivalence. Is that recognized by third countries such as the United States? Does that automatically carry over?
Oh, well, it would only be equivalence within the EU and
so in that instance, the UK would have to go through a separate equivalence test in the third countries.
Yes, so that actually goes again to the heart of it, in the sense that achieving equivalence is notoriously difficult, and I'm sure at least one of you will tell me that I'm wrong, but I'm not aware of any particular aspect of US and EU financial regulation that has in fact deemed to be equivalent. And it's because it's a trade issue. It's a trade battle, and people are holding, notwithstanding the policy objectives at the G20, which are all agreed and established and determined to be the right thing to do. Notwithstanding that everyone's gone and implemented those G20 objectives in their own way, those equivalence determinations haven't formally been achieved.
Actually, carry on.
The other side of the coin, which is the extent to which if the UK is retaining its EU form legislation, we're going to inherit a lot of provisions which say you're only allowed to do incoming business into the UK if you're equivalent, or UK participants are only allowed to participate on your markets if you're equivalent. So then we've got a bit of a decision about what we do about those. You know, do we grandfather things like, for example, the CCP equivalence decisions for the US? And if we do, then we take CME, we say CME is going to be equivalent, but then you've got the question of all the agreements that there were between the EU and the US around access of EU CCPs to the US markets and the terms on which they could access those markets. We're not automatically going to inherit that, and that's something that we're going to have to negotiate. So I think that's another side of the coin to consider.
Indeed, but just can I ask you, just this notion of grandfathering, what are the implications and what are the issues around grandfathering? What does it actually mean?
Yeah, I mean, obviously it's a massive question. It kind of depends on what exactly is being grandfathered. But so if we're saying that if we look at maybe just a narrow situation where we're talking about inheriting all of the European regulation, which would otherwise have been directly applicable, it's going to be a matter of looking at the role of the ESAs in UK markets for that transitional period. So, you know, what kind of role is ESMA going to have for things like the short selling regulation, where ESMA has the power to temporarily ban short selling in certain instruments? Would the UK authorities say, okay, that's great, that's part of our legislation now, maybe just for this transitional period, maybe for a longer period. So because ESMA's banned that, we're going to ban it in UK markets as well. You've got things like the equivalence determinations. I suppose you've got the role of the ECB. You've just generally got the role of the European institutions. And of course, all the cross-references that we've got in existing legislation, like FISMA, all the cross-references that we've got to European legislation, European institutions. Yeah, I mean, I don't have an answer to it, but it's definitely something that's got to be considered, is how we treat those grandfathered provisions.
Indeed. Michael, can you just pick up this issue, because that's a key point, is about the relationship that we have today with the ECB, with the single stability mechanism, single resolution mechanism, with the European Banking Authority, ESMA. These are sort of slightly sort of convoluted issues. What does the UK relationship become with these under equivalence or non-equivalence? I mean,
I think I would just sort of pick up the point mentioned before, that it is a highly sort of political decision. I mean, for example, I had always thought that the third country regime was based on third countries that had a different philosophy but achieved broadly similar outcomes. It was interesting, there was an article by Marcus Ferbier today talking about actually the same outcomes. So, you know, I think it's very hard to say at this stage.
It is. And Andrew, you know, I had lunch today with someone who was very much at the forefront of the Leave campaign for the city, and his view was that the result was the result, but at the end of the day, that wise heads will prevail. Is he just being a bit of a sort of idealist here around all of this?
We go back to sort of Rosalie's comment there. There has been a lot of convergence internationally in regulation in recent years, and I don't think we're going to see an end to that. There may still be a national overlay, but the general sense of direction is towards convergence. And much of the recent regulation has come through the Financial Stability Board, through Basel as global standards, through IOSCO, and I don't think there's going to be a bonfire of regulation anytime soon.
Just pick up on a couple of points related to that, which is Rosali is absolutely right. There is this international framework of regulation, but one thing we also have to bear in mind is that there have been a number of really significant policy priorities that the UK regulators have had, and they've had for a number of years. And those things are now being reflected in European regulatory developments. But in many ways, the UK regulators have been at the forefront of driving those things. So take, for instance, in the asset management sphere, the rules that we see coming in MiFID II in relation to the purchase of research using dealing commission. That's something that's been a real concern for UK regulators for a decade. It's now coming in MiFID II. Even if we didn't implement MiFID II, that would still remain a domestic concern here.
That's a key point, Thomas. That point of the UK regulator driving so much of the European body of legislation around capital markets. And I guess the point really is that in the event of an exit from the European Union, the UK is still a member of the G20, which has already been mentioned, and so and this is a globalized industry. Let's be clear, and. Because there's also been talk about, well, if the UK left, then the UK legislative framework would be actually more relaxed than the European one, which I think is perhaps erroneous. even around things like bonuses and getting rid of the cap. But I guess my question would be, is this whole business of getting sort of angst-ridden around exiting from the European Union perhaps a red herring on that basis that Whitehead will prevail, we're part of the G20, and the UK has got a pretty good record of setting a pretty good body of legislation?
Let me give a statement that goes in the opposite direction. The UK influence to some extent in world forums was based on its ability to speak with and to some extent for the European Union as a whole, in that it helped form a consensus within the EU, and therefore the voice that the UK had in international forums was not just the UK, but more broadly on behalf of the EU. I think it is, there are certainly people in the EU 27 who are both ready, willing, and able to speak on these issues and have definite views, that they would be content to have the UK have the same type of voice is, in my personal opinion, doubtful. And the ranking within the G20 or the G7 of the UK as not as standalone as rather than part of the EU must be different than what it is today.
Yeah, is that a general panel view that the UK basically derives its power from being part of something else? On a goes-alone basis, we're kind of sunk.
I wouldn't say we're sunk. I hope we're not sunk, but that is absolutely right. That although clearly we ignored him, but President Obama told us as much, and it was part of our soft power of being part of this larger organisation.
I think we have to not lose sight of the fact that the UK, London in particular, is and will remain for the foreseeable future one of the major financial centres in the world. And for that reason, I think we will always command a place in the discussions at the G20, the Financial Stability Board. That doesn't necessarily suggest that our sort of sphere of influence perhaps hasn't shrunk somewhat. I think, though, for me more particularly, the loss of our ability to have a voice in the European legislative process is something I find quite concerning. Even if we take the view that the European regulation won't bite directly on London-based institutions, our institutions are stakeholders in the European-based regulated entities. We're expecting later this year, for example, a legislative proposal on central counterparty resolution. We're not going to have a voice in the remainder of that process, and yet London-based banks and other institutions are substantial participants in European CCPs and will continue to be. So I think not having a voice in that process is a real loss for the city.
Yeah. I think also we can't cut ourselves off from the rest of Europe. So, we've still got the fact that London banks service clients all across the whole of the European Union. Those clients are still subject to European legislation. And you've got things like, for example, reporting obligations under EMIR, under MiFID, where the clients might look to the banks or the investment firms to provide those services for them. And if you're outside of the EU and you're not plugged into the EU infrastructure, you're not in control of, or you don't have a voice in how these reporting arrangements are organised.
Because, Rosali, so I guess the almost accepted wisdom, even at this early point, is that things like Euro derivatives clearing and other sort of Euro securities clearing and middle and back office will have to move to a Euro destination, even though we're not in the Euro. So,
well, you are aware, of course, that there was the big battle about that, and we actually won the case in the ECJ. The question is whether that privileged position will continue, and I think certainly the French, amongst others, are very keen for Euro clearing to go to the continent. I think an important point also to bear in mind in the context of what people have been saying in relation to the UK's voice is that I think that the UK's voice will be diminished even if we have the Norwegian option, and certainly when we have the other two options that Thomas posited right in the beginning. I do act for Norwegian clients, And it's not simple. That not everything, I mean, first of all, there's the issue around participation, but then there's also the issue around the status of the guidance of the ESAs, that doesn't actually apply. So you're actually in a slightly different regime. You can't actually influence things in the same way in which we can at the moment. And I guess I'm still in denial. One thing I'm still quite hopeful of is that there might be another model which will actually give us more of what we've got at the moment. But it's not clear that there's a political will to push for such a thing.
I'm saying in denial. I keep on saying we are where we are and we've got to make the most of it. Having said that, I think the EEA model is completely unacceptable on the basis of, I'm putting aside the free movement, but when you hit all of the other campaign issues, sovereignty, well, you're saying we'll just accept all the rules without having any say, and we'll make the financial contribution. So I hope that there will be some other model. Could it be, I don't know, some form of sort of a beacon of common law and good sense, which is obviously in very short supply at the moment. But as I say, a beacon of common law and good regulation, which enables us to attract business and, I've put it this way, I find myself reading Daniel Hannan's books now with a lot more interest over the last week, and I'm trying to accept and understand his arguments and hope that he's right. And I can imagine a world in which we do pivot away from Europe and we do become something like a damp and cold Cayman Islands, and hopefully not quite so lax, but providing a free trade, well-regulated environment which does attract financial services business from across the globe. And so just to make one more point, for all of the importance of Europe to the financial services industry, in particular the sort of legislative framework in which we've been operating in, I think it's important to remember that that the real drive to the single market in financial services is only 10 years old. It's there, and there was a world before that, and there will be a world after it. Whether it's as good or not or better, I don't know. But when you look at things like MiFID and the decision-making process, nobody can deny that it was not fast. It is a cumbersome, bureaucratic, for better or for worse. It is a slow process, and so, as I say, sort of adopting the Brexiteer mindset as best as I'm able to. The advantage of not being part of that is we will be able to be more nimble. And so, if you look at clearing, one of the things that I was thinking about before all of this happened was, well, look at what's happening in fintech. Is clearing really going to work in the same way in 5 years' time as it does today? Because if it doesn't, MiFID 2 is completely broken. It just, if clearing moves to a sort of blockchain type environment, I'm not saying it will, I'm not saying even that it can, but if it did, MiFID 2 just does not work. It gets completely bypassed. We, in theory at least, would be in a position where we could react far more quickly to that and perhaps even create an environment that supports and encourages it. But it is very much the wishful thinking, the optimistic thinking model, which I'm struggling to get myself into.
And the other jurisdictions have to allow people to come to that market.
They do, absolutely, yeah.
And just thinking, picking up on some of those points that Christopher mentioned there, the environment will always change. The markets in which we operate will continue to change, and therefore that presents some unknowns for the future. Certainly the debate so far just emphasises how many unknowns there still are. But the real question, if you stand back from some of this, I don't think answers will necessarily be forthcoming in the short term to some of these unknowns. In fact, we sort of see three phases. We're in this sort of volatility phase just now, market volatility, where there's some fear, there's also some looking at opportunities that this presents. We'll certainly move to the next phase, hopefully as we move towards September the 9th, it'll become clearer who's going to make the decisions on behalf of the UK, and then we'll go into a period of negotiation. But if we reflect on that negotiation period, certainly in the history of some of these negotiations in Europe and elsewhere, people keep their cards very close to their chest until the last minute. So that means many of the unknowns may not become known until we get much further down the deadline. We could be looking at least 2.5 years from now before we get some answers. And so when I sort of talk to firms and say, well, how do we move forward at this point? What do we do given there are these unknowns? I tend to sort of stop and say, well, we've got to sort of say, well, what must we do as a firm? Yeah? What sort of things must we stop doing at this point in time? What sort of things should we continue doing and perhaps even accelerate? And then let's make sure we know what the unknowns are. And to try and address some of those unknowns, the best way to sort of do it, given the uncertainty, is to try and look for flexibility in business and operating models. And if I look across the market just now, there's already a great deal of variation. If we take, there's some players in the capital markets who have a dual centre sort of operation for manufacturing and distribution. And certainly they're pressing ahead with all the existing EU reforms, MiFID and others continuing at full pace with implementation. There's others who don't have that model, but are looking just now and thinking, well, do I need that sort of optionality depending on where some of these big decisions land? And do I want to start building that optionality? And it's worth remembering optionality in dual centre models are what we used to call in previous years balkanisation. It comes at a cost. Usually there's a higher capital requirement and there's a higher cost of doing business. But that may be a price people pay because they want that sort of optionality just now. And if we get a better outcome, great. But if it's the worst case outcome, well, at least the business is fit for purpose.
I think picking up on that point about there being different models, we also need to keep in mind that the financial institutions in London have a very diverse client base. You know, some of the institutions that I'm talking to have a very London-centric client base, in which case Brexit should theoretically have a limited impact on them. What they need to be doing over the next period of time is actually keeping close to their clients and understanding how their clients might be reacting to Brexit, in which case their own client base shifting may well impact on their business of the future. For other institutions, you know, we have an enormous number of sort of subsidiaries of global outfits here in London. For them, actually thinking about, am I here because of the access to the European market? In which case, does this remain the right centre for me to be located in? Now, my personal take on that is, it is far too soon to be making any sorts of decisions. This is the right time for people to be getting their houses in order, to be understanding their business and their opportunities for future growth, and to be understanding what the options around regulatory frameworks might be. But very much a sort of a message of do not rush to the exit.
I think that particularly actually in relation to passports, and as I've mentioned, you know, we've all mentioned, different sectors of the industry use passports in different ways and to different extents. I also think, you know, increasingly over the last 4 or 5 years, people have exercised passport rights, particularly, you know, cross-border service passporting rather than establishing branches. But they've exercised those passports just because they can, because it's easy. And why wouldn't you, when you're going through your application process, why not tick those boxes without necessarily having put a huge amount of thought as to whether they're actually providing services into a given jurisdiction, and whether, or, you know, to the extent they feel that they're doing business in France or Spain or whatever it might be, are they doing business in a way that requires authorization in that jurisdiction? Now, the fact that we now have to think about it, or businesses have to think about it, is great for us on this panel, and less great for the businesses themselves. Yes. But there may be answers that are actually, you know what, we don't need that passport. We don't need to be authorized in Spain or Portugal.
There have been, there are a lot of issues around where exactly services are deemed to be being provided or activities are being deemed to be carried out, that because those passports have been there hasn't necessarily been the drive or the necessity for lawyers to really dig to the bottom of those issues. And maybe some of them will come to the fore a little bit more now because those questions are now perhaps more relevant and more key.
Yeah, I'm sensing a positive sort of vibe here around potential outcomes, but Rosali, I'll cut you off, but I guess my question was going to be, well, I guess do you agree that is the way to think about this? It's because not everyone, you're right, not everyone does use passporting, depending on who you are, and so losing that may not be an issue for a lot of people. And I guess the other question that I had in my mind was, a lot of the discussion to date has been around specific MiFID II. That seems to have been the one that everyone's really picked up on. Why is that such a kind of becomes such a huge issue?
Okay, there are quite a few questions in that, and there are also some other things I'd like to say, so if I can sort of try and take them in order. I think your point, Imogen, around do we actually need the passport is a very valuable point. And I think everybody here around the table have probably done numerous multi-jurisdictional surveys involving other countries, not the EU, where you do have to ask questions about what does it mean to provide services in your country. Is it enough that you just contact somebody in that country? If you contact that person and you have a flying visit, is that enough? Or do you need to have some form of presence? And all these sorts of questions become part of the analysis, and it can be quite complicated from a conflicts of laws perspective. So I agree with you, I think that's going to be part of the analysis. But I'd like to pick up on something which Andrew and Kate were talking about, which is around what do we do now? Do we actually have some form of dual setup? And I, very much like Kate, had the view that it's too early to do anything. But the trouble is, there are institutions who have enormous operations in London. And those operations are set up to provide services and across Europe. And for them to move those operations and to analyse whether they actually need to provide let's say, a form of broking into a particular European country or a particular form of insurance into a particular country, just that process will take more than 2 years. And that Article 50 notification is going to be such a crucial thing. We're going to really need to get, I would say, we urgently need the politicians to give us a better indication of when that process is going to start. Because 2 years is too short to move that kind of thing. Now, you asked me another question, which is around the focus on MiFID. I think the reason for the focus on MiFID is because one of the very controversial aspects of the negotiation in MiFID II was around third country access. And there were issues around having to set up a branch in order to provide certain services. And where we've actually ended up is with this bifurcated regime, so that you can choose to force firms to have a branch to provide services to retail clients. The UK and Germany are not exercising that option, but many other countries are. And then there's the issue around registration with ESMA under MiFIR. So I think that's partly why it has attracted so much attention. I think also it's attracted a lot of attention because it's actually quite detailed. So if you compare the passporting provisions in, say, for example, the CRR with the passporting provisions in MiFID, the MiFID ones are much fuller around equivalence and how it works and all that, whereas CRR talks about you can allow a branch to come in, you can allow third country supervisors to participate in colleges under certain conditions, and doesn't tell you that much more. So I think that's partly why people are focusing on MiFID. And then in fairness, MiFID does deal with rather a lot of the financial services landscape, but you're right, we shouldn't forget about things like AFMD or CRR indeed.
Yeah,
indeed. Could I just pick up a small point? We've talked a lot about passporting. It is a very topical issue. And I think there's definitely a lot of legal issues associated with it. But I think it's also helpful to stand back a bit from the legal side of things and think with a bit of dose of pragmatism and practicality around this. There's also a coverage model that goes with this. So it's all very well to be able to passport services into, say, Germany and sell a swap over there. But if you're not able to turn up on a plane and go and see your client and service your client there so easily, then the coverage model starts to break down. So I think it's helpful for institutions really to understand their current coverage model that's in place when analysing these issues and think from a business perspective too.
Yeah, indeed. Michael, if I just wanted to touch briefly, again, it's a kind of a subject also unto itself, but part of the negotiation or discussion around this is about what happens in things like bank resolution and the entire kind of bail-in regime, which I know is not entirely clear, even under the under the EU, with all sorts of get-outs for systemic state bailouts, which is Italy's trying to push, and so on and so forth. But in the event of the UK exiting European Union, what on earth happens to the bank resolution regime and the Capital Requirements Directive?
I think I'd probably have to pass that on to someone else.
Okay. Anyone? Yeah.
I'd be very happy to speak to that. I think that the key question there, and we've focused, and I think a lot of the sort of press on financial regulation is focused on questions around equivalence. But we do also have the recognition regimes that are absolutely critical when it comes to the sorts of prudential areas of regulation, like bank recovery and resolution, capital, and so on. It's sort of, we've talked about the activities provided by financial institutions. We haven't talked about the investment into those financial institutions. And I think that issue of recognition is absolutely key. If we go to the building blocks of the Bank Recovery and Resolution Directive, what it relies on across Europe are the provisions of the Credit Institutions Winding Up Directive. and the mandatory mutual recognition of insolvency and resolution actions in respect of banks and now also certain investment firms. Now, the key question there is, will that mandatory recognition be carried forward in some way? What we don't have in the UK is any form of compulsory recognition of another jurisdiction's insolvency or resolution laws. Full stop, nothing, other than the BRRD and CWOD. So if we move out of the EU, there's going to be a very political question mark as to whether we put in place some form of mandatory recognition of European resolution and insolvency laws. There is a lot of argument to say that for the sake of investor certainty, we should do that. There are certainly commitments at the FSB level for political agreement of recognition cross-border. We're yet to see that come into fruition. But I think too, it's sort of tainted by the experience we've seen in some of the other jurisdictions. You know, Cyprus is a good example, where there were very substantial legal questions as to whether the activity that was, or the resolution actions that were taken there should have been recognised here in the UK or not. And I think until we start to get some certainty around those questions, public policy type questions around treatment of creditors and the like, we're going to have that question mark over mutual recognition.
I think it's
what the fundamental approach on resolution, where the UK has had a thought leadership role, in my opinion, will not change.
I agree with that.
The structure, the ring-fence bank is likely to be preserved. I don't see that being changed. The emphasis on bail-in, the emphasis on putting investors at risk and not the taxpayer, I think will remain.
If I could just add to that as well. If we think of the BRRD, many of those provisions that Tom mentioned there were already part of a UK regime, with the exception of bail-in, which was introduced with the BRRD, but was certainly a principle that the UK was in favour on. So recovery and resolution as a concept, I think, is here to stay and is already enshrined in UK law and in regulation, regardless of the legal recognition rights, which are also a global issue of recognition, which the FSB acknowledges and is trying to harmonise across the various regimes.
Okay, I'm conscious of our time here, so we kind of flitted around various issues, but one thing I did want to pick up on, again, it's kind of a question, I guess, tailor-made for lawyers. A lot of the conversation and chit-chat around this whole area has been on the primacy of UK law, the jurisdiction of the European Court of Justice, and how that changes, does, you know, to what extent this impacts on things like even like contracts and so the law of contracts, which I gather written under UK law. Does anyone have any views on the UK law versus ECJ or European legal jurisdiction, and how that changes the nature of the capital market story?
Well, until we've repealed the European Communities Act, the position is as it is at the moment, which is that EU law is supreme.
Yeah, but I'm assuming that we've actually then...
Well, if we exit, I think it's going to be quite complicated, because there are issues then around whether we look at decisions of the ECJ, interpreting provisions, which I think we've all said we expect to be similar, if not exactly the same. So does that then become good guidance? I don't think it will be binding unless we're in a model whereby we recognise the ECJ as a binding jurisdiction. I don't think that's on the table in a full Brexit. So.
I would also add to that, I think that the sort of primacy of English law as a marketable commodity will not change, certainly not in our lifetimes. You know, you can see on this panel, you've got, I'm Australian, Rosali, I believe, is South African.
You're right.
And, you know, we've come here to the UK to practice our trade because English law is fantastic. And I think that stems from two things. One is the quality of the lawyers. And the second, yeah, exactly. I thought I'd get a laugh for that at least. And then the second thing is we have a legal system which is well understood, and particularly in the financial markets. And I can't see that changing.
Even if the EU 27 institute a provision that euro-denominated issues should be under the law of an EU member state?
Well, then certainly in that particular sphere, you know, we are going to see differences. But one of the things to remember here is that, you know, we use English law in documents for issuances all around the world, much in the same way New York law is used in that way. So you're absolutely right that if that was to happen, then there would be a diminution in the use of English law across the continent. But that's not to say that it's necessarily going to damage the sort of the brand of English law as a commodity, if I can put it that way.
Yeah, neither. Caroline, do you want to pick up? Because that's an important point, because English law and capital market tend to go, or New York law, but they tend to go hand in hand. That the international capital markets has grown in stature and size, partly, not only, but partly because of the fact that it's kind of anchored and documented under English law. So just the fact that that might be under threat, bearing in mind Thomas's point, does that kind of concern you at all?
Yeah, I mean, to go to Thomas's point, obviously the EU27 could pass some kind of legislation, but the question would be how they enforce that. And, we've seen restrictive capital market practices in all sorts of jurisdictions, and people find ways of structuring around it. And, to go back to Kate's point, English law and New York law, they've been used globally for issuances of...
I'd agree. I think, Thomas, if they did that, it would be an aggressive move and would clearly be in an unfriendly situation. And it would, of course, be, which I don't think anyone wishes or hopes for, but it's also a double-edged sword for the remainder of the EU, because they could find that by doing that, they push a lot of capital markets issuances into the UK or to New York or Singapore. There's no particular reason why European companies have to raise capital in Europe, and in fact there's not that much capital in Europe to be raised. So although we are on the back foot and we're all slightly staggered about the situation that we find ourselves in, it is still a two-way discussion. I don't know how heavy, how much weight of argument there is on each side of those two sides of the discussion, but it is still a two-way discussion.
I think the other element of background in referencing the comments that Andrew made earlier is that the principal players in the market are intensely practical. They may not be thinking of moving vast amounts, but the marginal decisions about where to invest are going to be determined by how they see this market developing relative to others. The growth is prospectively in emerging markets, prospectively in Asia. This market relative to other markets will determine where the marginal investment is going to be made. And that looking 10, 15 years down the road, it could be a very different picture. And
for better or for worse. It's just impossible to say at the moment.
Yeah.
I was just going to say, touching on this point of investment, so we go on to the subject, there's the Capital Markets Union as well.
That was my next question.
And it's interesting because when you think it's an interesting concept that there's real demand there, there's a supply of investors, a lot of the intellectual capital required to make it happen is sitting in London. And the success of the Capital Markets Union is not only important to the UK but to European countries. And indeed, it would be a real shame if there couldn't be a pragmatic approach to dealing with all this that unleashes that potential. And it's not like 40 years ago when we joined the EU, when there was very much isolated economies sitting side by side. We're very interconnected now, not only in financial services, but you take the intellectual property that swims around other industries like the airplane manufacture. You've got parts in the UK, Germany, France. That intellectual capital and property is sitting across places. But when it comes together, it allows us to create a champion that can rival other global champions in that field.
Yeah, I'd want to just talk very briefly about Capital Markets Union, because that was a centrepiece of Jonathan Hill's tenure as EU Commissioner, and he obviously he's clearly gone now. And it was actually progressing on, I think, a number of fairly positive fronts, be it private placements, securitization, green finance, infrastructure, and so not being part of that, extrapolating forward. Michael, can I ask you to comment just generally on the sort of the Capital Markets Union piece and having the UK not in that sort of debate? How important do you think that might be?
Well, as you say, it actually was something that was driven a lot sort of by Lord Hill. I mean, the latest comments are that the European Union still wants to press ahead with that. I think it's very hard to say, quite well where that will end.
Imogen, is this going to be a kind of a real sort of a negative point for the UK not being part of CMU?
I think it's a very similar theme to many of the other ones that we've talked about.
Yeah.
There are downsides to being outside. It's a shame that we won't have the same voice as we perhaps had in relation to it with Lord Hill. His replacement has, as Michael rightly says, kind of really talked about pressing on and talking about the now added importance of progressing capital markets union now that London, being one of the major financial centres, the major financial centre in Europe, isn't going to be part of the European Union. So that's kind of intensified that desire to get going and focus on capital markets union within the remaining EU.
Yeah.
I think perhaps in that context, though, it is important to keep in mind some of the sort of restrictions or limitations as to what the Capital Markets Union project is frankly capable of achieving. You know, one of the things that came out through, I think, one of the very early Commission green papers on the Capital Markets Union was the fact that the European capital markets are not as broad and deep as they are in the United States, for example. We have the barriers of multiple languages, significant cultural differences. You look at the Italian banks, for example, what we're seeing in the press at the moment about how Italy will go about rescuing those banks is driven by the fact that the investment in those banks, the equity instruments, are held largely by retail investors. Now that's sort of an odd situation compared to other parts of Europe. So actually harmonising some of those very substantial cultural differences, I think, is probably one of the biggest barriers to Capital Markets Union working. And that's not going to change whether we're inside or out of it.
Okay, that's a good point. Look, I've got we'll finish in the next few minutes, but I just wanted to ask kind of around the table, it's a kind of yes or no question, really, I guess, but feel free to elaborate. Let's assume that the UK exits European Union. Let's say in 3-5 years' time. I know it's an impossible question. In 3-5 years' time, does London still maintain its primacy as either the most important or one of the most important global financial centres? So yes or no, but please do elaborate.
Yes, and so in the hours following the referendum result, in the sort of drunken social media conversations that I was having certainly at the time, I discovered that, also I was informed in no uncertain terms that London on its own would, the nominal GDP of London would make it roughly the 6th largest economy in the EU. So will London's position and status change? Yes, of course it will. And how it will change, we've all agreed it's impossible to predict. But I think there is an impetus and a momentum to London that takes a lot of diverting. And so, we're all here, and I think we've got to make the most of it and make the best of the opportunities as well as the threats that Brexit presents. And I think London's always been good at doing that.
Okay, thanks. Kate?
I would agree. I'd wholeheartedly say yes. And I think there's probably two limbs to that I'd draw out. One is cultural, and the fact that London is a very, very attractive place for people to be, for people and business. I think historically, London has always been an attractive place to be. It will remain a diverse place. And then I think the second thing is the City of London's willingness to adapt, which is, again, something it's done through the course of history. I sat in this morning on a City of London Corporation discussion around innovation in the fintech sector, and there is a huge will and appetite to encourage that and the presence of that here in London. I think while we're working our way through these very murky waters with those sorts of attitudes, we'll come out at the other end in a reasonably strong place.
Okay, good. Caroline?
So I think I'm yes as well for the same reasons as Christopher and Kate. I think maybe additionally there's a critical mass element to it. So people are looking at different places where possibly they could go around the EU. People are looking at Dublin, they're looking at Frankfurt, they're looking at Milan, Paris, maybe Netherlands, Luxembourg. Unless you've got everyone going to one single place, you're not really seeing a significant competition to the City of London. And I think while that's still the case, the City of London still does have some sort of cohesion, and it has that critical mass which retains its character.
Thomas, are you going with the flow?
Not quite.
Yeah, great.
Let's not forget the rise of London as the global financial centre was started by something as simple as the interest equalization tax revision in the United States. I would say that Brexit is somewhat greater in significance than change in the interest equalization tax. The technology is also something that makes it possible to do financial services in a manner that is not as reliant on a financial center as formerly. So I would draw perhaps a comparison to Wimbledon. A veteran was down 2 sets love, and I think that may be the situation that the City of London is facing. Let's see if the City of London does as well as Mr. Federer.
Very good. Thanks, Rosali.
I also think that London will remain an important centre, but I think we might see other centres becoming at least as, if not more important. At least there's the possibility of that. I see a lot of business going to Singapore. I think that will remain the case. I'm not sure that with our sort of bad start now with Brexit that will effectively remain larger than New York, because it's been head on head for quite a long time. So I think London will remain important, but whether it will remain the most important, I doubt.
Okay. Thank you. Michael?
I agree with Rosalie. I think London will remain strong, but I think it could lose a bit of its shine, particularly with particular areas migrating. I don't think all together. Some business perhaps migrating to Amsterdam, to Dublin, to Frankfurt, and in the longer term, who knows? It will depend on actually the deal that's agreed.
For sure, yeah. Imogen?
Look, I agree. I think London will remain strong. There's a lot of thought going into the possible kind of benefits and disadvantages of alternative locations. Rosalie's right. It won't just be in the EU that people are thinking about. They'll think about locations outside. But even in the EU, when you think about the benefits of being inside the European Union, but if you look at moving to Paris or you look at Frankfurt, it's complicated. There are issues quite separate from those that pertain to financial services regulation that make those locations more or less attractive. It's not an easy task. So I think London still is going to have a lot to offer.
Okay, perfect. So Andrew, you're the last, but
maybe just
feel
picking up
free.
on some of the points we've touched on today, the reasons why there's some stickiness around London. Certainly we've talked about the sort of expertise that sits here, especially around manufacturing product. And then in a sort of tribute to my fellow panellists, the English rule of law and English law, certainly another stickiness factor. Something we haven't touched on, which is just the infrastructure that exists, including the markets infrastructure, payment, settlement, clearing, which has certainly stood up well under volatility in recent times, another plus. And then just that human dimension behind everything, which is just where do people want to live and base their families. These are all things which have to be taken into account. And just as firms have to look at perhaps optionality for the future, London too creates optionality for itself.
Yeah. Okay, my final question. I don't want to finish on a particularly negative note, but I just wanted to get a sense from the panel as, what's the nuclear option? So what's your worst nightmare emerging? What are your biggest fears around the UK exit, in as far as it pertains to capital markets regulation? Are there sort of things that you think, if this happens, we're all toast? Are there sort of generals, if we say, well, we're going to go to a bilateral trade agreement option, and how does that impact financial markets? Because we won't know for probably 20 years. But are there?
My greatest fear, and we now know that we have at least one candidate for PM who wants to do it, is someone who just presses Article 50 without having any idea as to what the ultimate objective is. Because, actually just thinking back over the last week or so, the day of the referendum result was kind of shell shock. Then the weekend and the Monday and Tuesday was panic. Oh my God, what's going to happen? And then everyone settled down with the cool heads and thought, okay, nothing's really changed. It's not the time to panic yet. But if that Article 50 is triggered without a very clear intention, look, I think the industry needs to decide what we want, the various aspects of the industry, and we should be advocating for it. But whatever it is, unless there's a very clear direction of travel, when Article 50 is triggered, that's when we'll see huge amounts of panic and transition of business, because people will be looking for certainty.
Okay. Anyone else got any thoughts?
probably along the same lines. I think probably messaging from the authorities is absolutely key. So hinting that you're going to press the Article 50 button tomorrow, talking about a bonfire of regulation, which might then, because a lot of the aspects of our continuing relationship with the EU are so politically driven, if we start talking about having some kind of, let's say, wholesale drawback on the transparency regime under MiFID II, people start thinking, well, actually, is the UK going to be equivalent on day one? It starts creating that, as you said, uncertainty, which then spooks the markets and maybe prompts people to withdraw.
That the US and other third countries mean what they say when the UK would be at the back of the queue for trade agreements and financial equivalency.
Maybe just thinking of, apart from sort of nightmare scenarios, that's certainly one big challenge, regardless of the uncertainty and where decisions lie, is I think many firms are going to have to do an awful lot of client consultation, repapering and recontracting, which itself is a huge issue and demands a lot of resource.
Yeah, absolutely. No? Okay. All right, so I think...
You're going to end on a positive note.
I'm going to pause. Yeah, I am. Yeah, I'm going to go. It's just another round the table. So if you just very briefly, just because we're kind of over time a little bit, if you had to summarise your perspective on where we go from here, using adjectives as described. So are you hopeful, optimistic, fingers crossed, depressed, negative? What's up from you this time, Andrew? Just as a final kind of, here's my kind of viewpoints on this.
I think it's that sort of idea of optionality. There's lots of unknowns that won't be settled soon, and therefore it's important to understand what you've got to do, things to stop, things to continue, but create optionality whichever way some of these key decisions land.
Perfect, thank you.
Completely agree. I'm possibly in the fingers crossed camp.
Fingers crossed, okay.
Hopeful.
That's good.
Fingers crossed.
Michael?
I think I would be in the fingers crossed camp.
Fingers crossed. Okay, I'm sensing a bit of a trend here.
I'm afraid I'm not going to buck it because I think it's too early to actually be completely negative. And frankly, if we're all negative, we're not going to end up in the right place. I think we somehow need to be part of a process to get the best out of this that we can. So the Article 50 pressing the button thing is key on that, but that means understanding what we really want.
Okay.
It's a big world. The world is full of opportunities as well as threats, but the global firms will go where they think the opportunities are. Let's hope the UK is one of them.
Okay, very good. Caroline?
Yeah, I think I'm hopeful. I'm hopeful that, now that it's actually happened, we know that we've got a leave vote. People can focus on what the options are, really work through how we're going to take this forward. And there's a lot of clever people behind this.
Indeed.
Somewhere.
Okay, I'm not sure if hopeful is better or worse than fingers crossed, but I guess it's a similar sort of area.
I think this is probably a little bit unsexy, but being the lawyer that I am, I'd say analytical. This is about actually understanding the realities that we're in, insofar as we can, and then being very flexible and open-minded about what we don't yet know, which I think probably harks back to Andrew's points around optionality.
Yeah, absolutely.
I'm a variation of the fingers crossed approach, which is, look, there are some huge downside risks here, but there are upside possibilities. And I think our industry, our clients need to decide what it is, where those upsides are, and they need to be out there fighting for them and advocating for them right now.
Yeah. Okay, perfect. I think that's a perfect place to finish. So thank you so much for, I guess, a difficult panel because none of the answers are out there. It's just, we're slightly in uncertain territory. And so, I guess we'll wait to see how things evolve. And maybe later in the year we'll reconvene and have another go. But in the meantime, thanks for your time. Appreciate it.
Thank you.
Thank you.
Thank you for the invitation.
Thank you.